Two people. Emma is 28. Tom is 38. They both decide to invest exactly £500 a month. Same amount, same fund, same approach. But Emma starts today. Tom waits 10 years. They both stop at 53. Emma invests for 25 years. Tom invests for 15. Emma puts in £150,000 over her lifetime. Tom puts in £90,000. Here's where it gets interesting. Emma ends up with £433,000. Tom ends up with £173,000. Emma didn't invest more talent, more brains, or more luck than Tom. She just started 10 years earlier. Those 10 years are worth £260,000. By the end of this video, you'll understand exactly why and exactly what to do about it. Here's the thing most people get wrong about investing. They think £500 a month isn't enough to bother with. They're waiting for the right moment, when the car's paid off, when the kids are a bit older, when things feel more settled.
But the right moment is a myth, and the cost of waiting is one of the most underestimated figures in personal finance. Because when you delay investing, you don't just lose this year's growth, you lose every year of growth that growth would have earned, compounding forward, forever. Tom didn't wait because he was careless. He waited because he genuinely believed he had time. That belief cost him £260,000, not from one bad decision, not from one bad year, just from waiting. So let's go through exactly what happens when you invest £500 a month in the UK, year by year, pound by pound. First, you need to understand the engine behind all of this, compound interest. You've heard it called the eighth wonder of the world. That's a bit dramatic, but the maths genuinely does get strange over time. Here's the simplest way to think about it.
Imagine a snowball at the top of a very long hill. In the beginning, it's tiny. It picks up a little snow. That snow picks up more snow. And that snow picks up more snow again. The snowball doesn't just get bigger. It starts growing faster than you're pushing it. That's compound interest. Your money earns a return. That return earns a return. And that return earns a return. Over short periods, it barely registers. Over 25 years, it transforms everything. Now, where to put this money in the UK? We have something called a stocks and shares ISA. You can contribute up to £20,000 a year into one. £500 a month is £6,000 a year, comfortably within that limit. Inside the ISA, every penny of growth is completely tax-free. No capital gains tax when you sell, no income tax on dividends. HMRC gets nothing.
Every pound of return stays yours. Over 25 years, when the returns start compounding into serious money, that tax protection is worth an enormous amount. And what do you actually put inside the ISA? For this, a low-cost global index fund, something that tracks thousands of companies across the world, diversified, simple, with annual charges of less than 0.2%. You're not trying to pick winning stocks. You're buying a small slice of the global economy, automatically every single month. Now, here's where it gets really interesting, because this is the part most people completely miss. Let's go year by year. Day 1, you set up a direct debit. £500 leaves your account on the 1st of every month. It lands in your stocks and shares ISA. It buys units in your index fund. You don't check it daily. You don't watch charts. You set it up and you get on with your life.
Year 1. You've invested £6,000. At an average annual return of 7%, your pot is worth roughly £6,400. Not exactly life-changing. It barely feels real, but the engine has started. Year 2. Another £6,000 goes in. Your pot is now around £13,100. Still modest, but here's what's already happening. Your year 1 money isn't just sitting there. It's growing, compounding on top of itself, silently, automatically, while you sleep. Year 5. You've invested £30,000 of your own money. Your pot is worth around £35,800. That's £5,800 you never put in. Not life-changing yet, but it's a sign of what's building underneath. Year 8. You've invested £48,000. Your pot is worth around £62,000. That's £14,000 in returns. Your portfolio is generating roughly £4,300 a year in growth, still below your £6,000 in annual contributions, but the gap is closing fast. The snowball is developing real weight.
Year 10. This is when most people sit up and take notice. You've invested £60,000. Your pot is worth around £87,000. That's £27,000 you never contributed. Over a quarter of your portfolio is pure return, money that wasn't earned through work. It was grown. Think about that for a second. You haven't changed your income. You haven't taken extra risk. You've just stayed consistent. In a quarter of your portfolio appeared from nowhere. You're still adding £500 a month, just like you always have. But something has quietly changed. Your money is no longer just relying on you. It's become a quiet second engine, running alongside everything else you do, automatically, invisibly, building momentum you can't earn through work alone. Now here's the part I haven't told you yet, and this is the bit that changes everything. Year 17. At this point, your portfolio has grown to roughly £210,000.
At 7% annual return, it generates approximately £14,700 in growth this year alone. You're contributing £6,000 a year. Your investment is contributing £14,700. Your money is now working harder than you are. Let that land for a moment. You put in £500 this month. Your portfolio quietly generated the equivalent of £1,225 just by existing, just by being there. From this point on, the gap between what you put in and what the portfolio generates gets wider every single year. You haven't changed anything. The snowball just got big enough to roll on its own. Year 20. You've invested £120,000. Your pot is worth around £271,000. That's £151,000 in returns, more than your entire lifetime contribution, sitting on top of it, generating more. Year 25. You've contributed £150,000. That's £500 a month, every month, for 25 years. Your stocks and shares ISA is now worth approximately £433,000.
£283,000 in returns, nearly double what you put in, generated by compound growth, inside a tax-free wrapper, without you lifting a finger after that first direct debit, and not a penny of it taxable. That matters more than most people realize. Outside an ISA, that £283,000 in gains would attract capital gains tax on anything above your annual allowance. Inside an ISA, HMRC can't touch any of it. Now, let's go back to Tom. Tom starts at 38, not 28. Same £500 a month, same fund, same 7% return, but only 15 years to compound, not 25. His total contribution is £90,000. His pot at 53, around £173,000. That is still a brilliant outcome. Tom has done something most people never do, but the 10-year gap cost him £260,000. Not because he invested less, though he did put in £60,000 less, because compound interest magnified every single missed year into something brutal. The money you don't invest today doesn't just miss this year's return. It misses every return that return would have earned, compounding for 2.5 decades. That is what early investing buys you. Not a higher salary, not a smarter stock pick, just time. I know what some of you are thinking. Starting in your 30s or 40s, is it too late? It is not too late. Tom's outcome is still transformative, but every year from now tightens this curve against you. The best time to start was 10 years ago. The second best time is today. There's one more thing worth knowing, and this is the multiplier most people completely overlook. If you're employed, your employer is almost certainly contributing to a pension on your behalf. Under auto-enrollment in the UK, the minimum total contribution is 8% of qualifying earnings, and your employer must cover at least 3% of that. That is free money, on top of everything we've just discussed. The year-by-year numbers we just walked through assume you're investing alone from your own pocket with no outside help. Most employed people in the UK aren't in that position. Add employer contributions into the mix, and the curve we just walked through accelerates significantly with someone else's money helping it along. So, what does all of this actually mean? And what do you do next? 1. Start today. Not when things feel more certain. Not when the market looks calmer. There is no perfect moment. Markets go up, markets go down. None of it changes the 25-year outcome anywhere near as much as simply starting. Tom thought he had time. He did, just not as much as he thought. 2. Use a stocks and shares ISA. If you're investing for the long term, there's almost no reason to do it outside a tax-free wrapper.
HMRC takes nothing from inside your ISA. Over 25 years, with returns compounding into six figures, that tax protection alone could save you tens of thousands of pounds. 3. Choose a low-cost global index fund. You don't need to pick stocks. You don't need a financial advisor or a view on which sectors are about to outperform. A global tracker, something like a FTSE All-World or Global All-Cap Index, gives you exposure to thousands of businesses across dozens of countries for less than 0.2% a year in charges. The less you pay in fees, the more compounds. 4. Automate it. Set a direct debit for the day after payday. Make the $500 invisible, gone before you can think about spending it. The most successful investors aren't more disciplined than you. They've just made it harder to stop. 5. And this is the one most people get wrong. Don't stop when markets fall. When markets drop, your 500 pounds buys more shares than it did last month. You're buying at a discount. You're not losing money. You're accumulating more units at a lower price. The snowball isn't shrinking. It's picking up extra snow. Every major stock market crash in history, 2008, the dot-com bust, the pandemic crash in 2020, has been followed by a recovery. The investors who kept going through those dips came out ahead of everyone who paused. Remember Emma from the start? She ends up with 433,000 pounds, not because she was smarter than Tom, not because she took more risk, not because she earned more. She got there because she started 10 years earlier. That's it. The tipping point, year 17, when your money starts working harder than you do, isn't a fantasy. It's arithmetic. And the only condition is that you begin.
If this video gave you a clearer picture of what 500 pounds a month could actually do for your future, this is what we do here every week. Real numbers, plain English, no jargon, no suits. Just your money explained. Hit subscribe. New video every week. Set up that direct debit. Until then, this is Monkey Finance. See you in the next one.